Welcome back. This video will go over the FIFO and LIFO inventory flow assumptions. If you didn't watch my previous introductory video to the topic, I'd recommend doing so before proceeding. Let's start with FIFO. Remember, first in, first out means that the first inventory purchased is deemed to be the first inventory sold with each transaction. The following animation is a good representation of how FIFO works. Let's consider those same purchase and sales transactions from my previous lecture regarding specific identification. Let's record these same transactions using the FIFO cost flow assumption. Our beginning inventory. I'll present the cost flow calculations within the following columns. As of the beginning of September, merchandise inventory has a beginning balance of $26,800. The number of units on hand multiplied by their cost. On September 4th, we acquire 120 units at $690 per unit, or $82,800 worth of merchandise inventory. I'll show the journal entry as a partial review. Presuming this were a credit purchase, we would debit merchandise inventory and credit accounts payable for $82,800. Consequently, we add this purchase to our current inventory. I like to think of merchandise inventory as layers. First, we have our layer of beginning inventory, and we add a new layer for the 120 units purchased at $690 per unit. On September 7th, we make a sale. Recall our entry for selling merchandise inventory. First, we increase assets with a revenue. Treating this transaction as a credit sale, we'll debit accounts receivable and credit sales revenue for $67,200. The units sold multiplied by the sales price. We also need to debit cost of goods sold and credit merchandise inventory, but for how much? This is where our FIFO cost flow comes into play. We sold 60 units, and the first inventory purchased is the first considered to be sold. So we sold all 40 units from beginning inventory at $670 per unit. And the remaining 20 units came from the most recent layer at $690 per unit. Sum these two products together and we get our cost of goods sold for the entry, $40,600. I would normally present the journal entry on 4 rows as follows, but to be more space efficient, I'm showing them as you see here. Hopefully, this deviation from the norm isn't confusing. How much inventory do we have left? We exhausted all of our beginning inventory, so we now have 0 units at $670 per unit. And taking the 20 units from that last layer leaves us with 100 units at $690 per unit, yielding a total merchandise inventory balance of $69,000. On September 15th, we make another sale of 50 units. Again, record the sales transaction, debit AR and credit sales for $56,000. Next, we need to determine our amount to debit and credit to cost of goods sold and merchandise inventory, respectively. This one is easy. We only have one inventory layer to pull from. So all 50 units come from the only remaining layer of $6.90 per unit, for a total cost of goods sold of $34,500. This deduction leaves us with an inventory balance of 50 units at $6.90 per unit, also $34,500. On September 18th, we purchased 100 units at $700 per unit. Our purchase journal entry for this presumed credit purchase is a debit to merchandise inventory and a credit to accounts payable for $70,000. Again, we just multiplied the number of units purchased by their purchase price. Now we have a new inventory layer to add to our previous one of 50 units at $6.90 per unit. Add in that $70,000 worth of merchandise inventory, and we have a new merchandise inventory balance of $104,500. September 21st brings us another sale of 80 units. Debit accounts receivable and credit revenue for $89,600. Debit cost of goods sold and credit merchandise inventory for the following amount. The 80 units sold took all 50 units from our oldest merchandise inventory layer at $6.90 per unit, and 30 units from the most recent layer at $700 per unit. So $55,500 is our debit to CGS and our credit to merchandise inventory. Our remaining merchandise inventory will consist of just 70 units at $700 per unit, or $49,000. The entire oldest layer is gone, and only 30 units taken from the previous quantity of 100 units is how we arrived at 70. We make one more sale on September 25th. Just 30 units at $1,120 per unit. Debit accounts receivable and credit sales for $33,600. We'll debit CGS and credit merchandise inventory for $21,000. We only have one inventory layer from which to pull our sales. So 30 units at $700 per unit is our cost of $21,000. If we sold 30 units from our remaining 70 units, we only have 40 units left at that cost of $700 per unit, or $28,000 of merchandise inventory remains. On September 29th, we finished the month with one last purchase of 120 units at $707 per unit. So we debit merchandise inventory and credit accounts payable for that product of $84,840. Add that newly acquired inventory layer to what remains from our previous one, and we have ending inventory for the month of $112,840. That's certainly a lot of information. If you want to check your work, you can do so using that same formula and method from my previous video. We have our beginning inventory of $26,800. Next, we take our purchases. On the right side of the equation, we have our ending inventory of $112,840. And all of our cost of goods sold amounts. Work this out, and you'll get $264,440 equal to $264,440. LIFO, last in, first out. This one is as self-explanatory as FIFO. The last inventory purchased is the first deemed to be sold. Let's re-examine our previous example, only under the LIFO cost flow assumption. We can trace those cost flows using the exact same method we saw with our previous example. We start off with our beginning inventory of $26,800. So far, no difference. We make our purchase on September 4th, in which we debit merchandise inventory and credit accounts payable for $82,800. This purchase will once again become our new inventory layer when combined with our beginning inventory. Together, they yield a new balance of $109,600. On September 7th, we have our first sale of 60 units. The journal entry will consist of a debit to AR and a credit to sales revenue of $67,200. We'll also debit cost of goods sold and credit merchandise inventory. Under LIFO, since we're pulling from our most recent layer first, then working backwards, we have more than enough units in our most recent layer to make up these 60 units. So we'll just multiply 60 units by $690 per unit to get a cost of sales of $41,400. For our remaining inventory, we have 60 units left at $690 per unit, and we didn't take anything out of our beginning inventory, 40 units at $670 per unit. Total inventory balance comes out to $68,200. We have yet another sale on September 15th. Debit AR and credit sales for $56,000. As in the previous transaction, we have more than enough units in our most recent inventory layer to go into our sales. So all 50 units will have a cost of $690 per unit, meaning our debit to cost of goods sold and credit to merchandise inventory will be $34,500. Our remaining inventory will consist of 10 units at $690 and the untouched beginning inventory of 40 units at $670. For a total of $33,700. On September 18th, we purchased 100 units at $700 per unit. So we'll debit merchandise inventory and credit accounts payable for $70,000. Add this purchase as a new layer to our previous ones. We now have 3 layers totaling to $103,700. On September 21st, we sold 80 units. Debit accounts receivable and credit sales for $89,600. Since our most recent layer has 100 units in it, all 80 units are assigned this cost, meaning $56,000 will be our debit to CGS and credit to merchandise inventory. Of the 100 units we had in our most recent layer, we now have 20 units left. Our previous 2 layers were not touched by this transaction, so the total inventory balance becomes $47,700. We have our last sale of the month on September 25th for 30 units. Debit accounts receivable and credit sales for $33,600. To get our cost of sales, we only have 20 units from our most recent layer to use, and we'll take 10 units from the next most recent layer at $690 per unit, giving us a total cost of sales of $20,900. These 30 units sold completely consumed our 2 most recent inventory layers. All we have left is our beginning inventory of 40 units at $670 per unit, for a total inventory balance of $26,800. Finally, on September 29th, we purchased 120 units at $707 per unit. Debit merchandise inventory and credit accounts payable for $84,840, and add that layer to merchandise inventory. Total merchandise inventory as of the end of September is $111,640. That same reconciliation of beginning inventory plus purchases equals ending inventory plus cost of goods sold still holds true. Take the beginning inventory of $26,800 plus your 3 purchases do the same with ending inventory and your cost of goods sold. Sum these 2 sides of the equation and you'll get $264,440 equal to $264,440. Again, while it's not an absolute guarantee that everything was recorded correctly, it's a good sanity check to ensure we can be confident in our results. That concludes this video on FIFO and LIFO cost flows. The next video will address the weighted average cost method and summarize the differences among our 3 assumptions. If my videos are helping you and you want to return the favor, you can leave a thumbs up as well as a comment below. If you really want to help, temporarily subscribe to my channel. not forever, just for however long you're taking your accounting course or courses. Finally, share my videos with your fellow classmates and possibly your instructor. I would like my videos to help as many students as possible, and I wouldn't mind getting some input from contemporaries. Thank you once again, and I'll see you in the next one.